Hey there, welcome to today's video on real estate investment trusts, commonly known as REITs. If you're interested in investing in real estate but don't want to take on the risk and hassle of owning property, then REITs might be the perfect investment for you. In this video, we'll go over what REITs are, how they work, the different types of REITs, and the benefits and risks of investing in them. So, let's dive in. What are REITs? Real estate investment trusts are companies that own and operate income-generating real estate properties such as apartments, office buildings, shopping centers, hotels, and warehouses. They offer investors an opportunity to invest in real estate without owning or managing properties themselves. Instead, they invest in a portfolio of properties managed by the REIT, which generates rental income and can appreciate in value over time. How do REITs work? REITs raise capital by selling shares of the company to the public, just like any other stock. They then use this money to purchase and manage real estate properties. The rental income generated by these properties is then distributed to shareholders in the form of dividends. In order to qualify as a REIT, the company must meet certain requirements, such as distributing at least 90% of its taxable income to shareholders in the form of dividends. Types of REITs. There are three main types of REITs: equity REITs, mortgage REITs, and hybrid REITs. Equity REITs invest in and own properties, while mortgage REITs invest in and own mortgages and other real estate debt. Hybrid REITs invest in both properties and mortgages. Benefits of investing in REITs. There are several benefits to investing in REITs, including diversification. REITs allow investors to diversify their portfolios with exposure to real estate without having to buy physical property. Regular income. REITs pay out a high percentage of their earnings as dividends to shareholders, providing investors with a steady stream of income. Liquidity. REITs are traded on stock exchanges, making them a liquid investment that can be easily bought and sold. Potential for appreciation. REITs can appreciate in value over time, providing capital gains to investors. Risks of investing in REITs. Like any investment, there are also risks associated with investing in REITs, including interest rate risk. REITs may be sensitive to changes in interest rates, which can affect their borrowing costs and the value of their assets. Real estate market risk. The performance of REITs is closely tied to the real estate market, and a downturn in the market can negatively impact their value and dividends. Management risk. The success of a REIT is largely dependent on the management team's ability to acquire and manage properties effectively. Regulatory risk. Changes in tax laws or regulations can affect the profitability of REITs. So, there you have it. An introduction to real estate investment trusts, REITs. REITs can provide investors with exposure to real estate while avoiding the risks and headaches associated with physical property ownership. However, like any investment, they come with risks, and it's important to do your research before investing. Thanks for tuning in, and I'll see you in the next one.